let's turn the music off, although I love the music. So, good afternoon, everybody. I'm Deborah Owens, and I'm founder and CEO of Wealthy You, where we help women of color build their first multi seven figure portfolios. And today I'm here because I'm starting my first or launching my first Lunch and Learn series. So if you want to learn more about investing or learn more about what you need to be doing in what is a pretty uncertain time, I'm double clicking on a specific topic, and it's the 4 R's of fearless finances. Now, make sure you join me for the next 4 weeks at noon on Thursday, because I'm going to be expanding on this topic of fearless finances and specifically what I call the 4 R's. Now, many of you may be thinking, why is she talking about fearless finances? The market is higher than it has ever been. And so I thought it was so important to kind of double click on this topic, because I heard someone describe the kind of situation that we're in as, what do I want to call it? The roaring 20s, right? And so talking about the roaring 20s, and it had me think about, what preceded the roaring 20s was the stock market crash of 1929. But I don't want you to think that I'm a naysayer. But one of the things I do know is that it's important as an investor for you to take calculated risk. And one of the other reasons that I wanted to double click on this topic specifically is because I've been watching a lot of content on social media, conversations in Clubhouse, and so many of those conversations lead with, oh, well, it's easy to make money in the stock market, and now things are different, and you have access to all this information. And so I'm going to show you the method for making money in the stock market without taking risk. Well, here's all I want to say to folks is that every investment comes with a certain amount of risk. And when you begin to think about things from a frame or from the perspective really of I can't lose, typically makes me feel like we are just about near correction. Now, I'm not trying to time the market. I've never done that. But, just a little bit about my background. I started in the investment industry several decades ago, and have basically experienced volatility and stock market crashes, whether it was 1987, the recession of 1992, the Y2K 1999, the early 2000s, and now 2008, which many of us experience. And so when I hear people framing or conveying to the public, especially in the guise of being financial experts, that now it's different and that you can't, that you don't have to worry if you invest in stocks because there's some magic formula, I always get concerned. Now, the other reason that I want to double click on the 4 R's of fearless finances is that there's another camp, right, of people who are viewing all this happening, and you're looking at the stock market and you're wondering perhaps, oh, well, maybe it's too late for me. Maybe this is a market top. I've been sitting in cash because of COVID, or I've have all my money in fixed income because of COVID, and now I don't want to invest because I do think there's going to be a stock market crash, and so that I'm going to sit on the sidelines. So, if, for those of you who are watching, in the comments, just share with me, did I describe any of your perspectives on how you might be thinking about investments and risk right now? Let me see if I can take a look at some of the comments in here and kind of get a sense of perhaps what you're thinking. Okay, so I've got my comments up. All right, so here's the point that I want to make in Fearless Finances today in this series. And the first, we're going to go through 4 R's. And the first of those R's is now's the time to that's right, George. We're followed by a depression, but not only that, the 1929 stock market crash. So, I mean, that's just a fact, right? And so, so thank you for that comment. And, I'm not being a naysayer. The point is that the market and all investments typically, come back to the mean. And so one of the concepts that that members in our Wealthy You society and our Wealthy You community are exposed to is taking calculated risk. And it all begins with, what is your risk tolerance? Because to be honest with you, just based on my experience, what I've learned is the people who are the most successful as investors know what their risk tolerance is, have different eggs in different baskets, and what it allows them to do is stay the course in spite of market declines, because that's really what the game is. I mean, that's really what the goal is to be able to weather the ups and downs of the stock market and not be sort of put yourself in a position where you are seeing all of your funds decline in value. Remember, I said decline in value, not lost. And so the next thing you want to do is run for the exits. So I think it's a really good idea right now for anyone who's listening, whether you're sitting on the sidelines or whether you have a considerable amount or a considerable percentage of your investments in the stock market, that the first R is reassess your risk tolerance. And what I mean by that is a couple of things. If you've been in the market and you have a considerable amount of your investments in the market, the truth is that we're at really, really heady highs, right? If you look at small cap stocks, if you're in a small cap mutual fund, some of those funds were up over 99% in the past year. If you're in large cap, some of you are looking at gains of 30, 40, 50%. And so with that, the fact that the market is up so high, what has happened is that you may have started out with 50% of your investments in stock and 50% of your investments in bonds and some in cash. And now you're looking at, now that percentage that you invested now may look like 60% in stocks or 70% in stocks. And so I really want to just convey to you that now is the time to reassess your risk tolerance, so that in the event we have some type of a correction, I have never tried to call the stock market in the years that I've been investing. But what I do know is that typically all investments revert back to the mean. So what do I mean by that? What I mean is the historical return on small cap stocks, maybe 13, 14%. The historical return on large cap stocks, 11, 12, 13%. Bonds over time have averaged, or fixed income over about 5.5%. And so what that really means is that if you're seeing, average annual returns in the past 3 years of like 30%, eventually those investments are going to revert back to the mean. So, what does that mean? It means that at all times we should be prepared for an economic downturn or prepared for the market to be very volatile and be prepared for the market declining. Now, why is this important? This is important because the most important thing you can do as an investor is to make sure that your investments are positioned so if the market were to decline, you won't become fearful and run for the exits. So if you have any questions though, so that's the first R of fearless finances, is to reassess your risk tolerance. Now, why do I say that? And most of you are probably thinking, "Oh, I'm never going to run for the exits. I know that stocks go up and down, and I'm prepared for a decline. And I know that if I invest for the long term, that I need to be prepared to see my investments go down." Here's what I know to be true. As someone who's coached thousands of women, someone who was an advisor to high net worth clients, is that couldn't be further from the truth, because that is a rational explanation that I just gave to you. And the truth is that when it comes to your finances and money, it's more emotional than it is rational. And I think the reason why I wanted to share this, I want to share this next story with you, is because it really helped me to understand how emotional money is, and how many times when you're stuck around making a decision, oftentimes it's not that you're stuck, it's that you're fearful. Okay, so the reason that the first R of fearless finances, reassess your risk, is so important, is because, excuse me, is because here's what happens. So, a client that, one of my first coaching clients when I started Wealthy You, and in Wealthy You, I don't advise. Basically, people are learning how to actually analyze and research their mutual funds, analyze and research their portfolios, so that when they sit down with a financial advisor or they have to make choices in their own retirement plans, they're able to do so from a position of knowledge and not fear. One of my favorite quotes of all time is by Ralph Waldo Emerson, who says that knowledge is the best antidote towards fear, right? So that is the whole premise and the foundation of what Wealthy You is built on, right? So one of my first coaching clients, we kind of review her situation. She had several $100,000 that she had saved for retirement. And when we went to kind of review where her investments were, what we learned that most of her money, and this is 2015, had been sitting in a pretty low yielding, what's called stable value fund. Those funds don't go up and down, they just go up. As interest rates go up, the yield or the return on those investments go up. And so and I asked her, well, why is your money still in it? Why is all your money in this stable value fund? Because I knew there's no way she could have accumulated those kind of holdings without having somehow been in the stock market. And she says, oh, well, in 2008, in 2009, when the market crashed, I took all of my money out of mutual funds, and because I wanted to wait and I didn't want to lose any more money. Again, one of the things I want to preface this with is the market declines. You only lose if you actually move your money out of your funds, and then you are actually going to experience some kind of loss. So, long story short, she said to me, "No, but I believe I put it back in to the stock market and I put it back into the mutual funds." I said, "Really?" I said, "So you've been getting your statements for, let's see, 2009, 2010, 2011, 2012, 2013, 2014. It's now 2015. You've been getting your statements. Didn't you notice that your investments were not like increasing over time, specifically because the market, you've seen the market has been going up?" And you know what she said to me? She said, "Oh, well, because I wasn't losing money, I wasn't concerned." And so the point I want to make is this is what can happen if you don't reassess your risk tolerance, right? Is that you could see the value of your investments decline, get very fearful, run for the exits, thinking that at some point you're going to go back into the market and forget to do so because you experienced that decline, and you actually experienced the risk. You're very fearful about going back into the markets. Do you understand? I want everybody to understand why this is so important. Is that it's not, reassessing your risk tolerance and having different eggs in different baskets is about you taking calculated risk, right? And so calculated risk means that you not only understand what the upside potential is, which is what everybody's excited about with the market being up and all these companies going up in value, but that if you experience a market decline, that you have positioned yourself in a way where you can actually say to yourself, "Oh, I know that I'm properly allocated between the type of risk, and I know that there is a portion of my portfolio that is not going to be exposed to stock market risk." Because here's the most important thing you need to understand about investing and to be a successful investor. And it's this. It's that the person or the investor that is able to really benefit takes a long-term approach and recognizes that it is in the long term that their money will grow, and that to be an investor requires you to take calculated risk. And that risk is different for everybody. Knowledge, typically, the more knowledgeable you become about the investment markets, how they work, how to analyze and research stocks, it increases your risk tolerance. But you know what? To be truthful, based on what I know, it's not only knowledge. A lot of it really depends upon your your exposure to risk and your wherewithal, how many assets you have to put at risk. And then I guess there's another factor, and that is some people are very aggressive by nature, and so as they learn, they begin to manage that risk. So the point I'm making to anyone that's listening is that in this economic environment, it is very, very easy to feel like the market is going to continue to go up and up and up. The truth is, all we have to do is look back to a year ago when the initial COVID pandemic happened, and we saw our investments or the stock market decline by 10, 20, 30%, right? And so even then, many people pulled out of the market and probably even now are sitting on the sidelines waiting for it to correct. Key point here. It is very, very difficult to time the market. And so one of the keys to really becoming a successful investor and being able to invest over the long term is making clear on what your risk tolerance is from the start and making sure that you reassess your portfolio. And now's a perfect time to do it. Many of you have just gotten your quarterly statements from your retirement plan or your brokerage account. Or, I guess it's a little more difficult now because for that to become a nudge or a prompt because, we used to receive those statements in the mail. Many of us are getting those statements in our online mailboxes. And so gets kind of mixed up with all that other email. What I want to encourage you to do, though, is to, if you got a notification that your online statement is available, that you really take the time to look at how the increase in the value of the stock market has maybe shifted the percentage of your investments that are being exposed to the stock market and bonds, and that you reallocate. Many of your retirement plans, you can go right in and you can rebalance that portfolio. Some people advise that you can choose the automatic rebalance, but I really want to encourage you to look even further. And I'm going to talk about the next R's, the next R's that you should do, that you should employ really to have fearless finances. So I hope you enjoyed my first Lunch and Learn on the 4 R's of fearless finances. The first R was reassess your risk tolerance. So your homework is to look at your quarterly statement, look at your statements from your investments, whether it's from your employer, your brokerage firm. Take a look at how, based on this market going up in value, what your current asset allocation is. That's kind of a technical term, but I just want to say, how much do you have in stocks? How much do you have in bonds? Are you comfortable with that? Do you know what the downside risks are? And really take an approach that can help you to be fearless with your finances. So I'm Deborah Owens, founder and CEO of Wealthy You. Join me again here next Thursday at 12 o'clock for our next Fearless Finances Lunch and Learn. If you want to join me in other platforms, you can go to our Wealthy You community on Facebook and join us there. Every week we have a Wealthy You Wind Down Wednesday. So we have a little fun with this serious topic. And of course, we're always doing training. And if you want to join with other like-minded women who are building their first multiple 7-figure investment portfolios, I hope to see you there. So again, go forth and prosper. And I'll see you right here next week.